Good morning. This is Larry Edelson for my Uncommon Wisdom video for Thursday, March 25th. We have a lot happening, so let me cut right to the chase. In Europe, we're seeing a lot of tumult over whether or not to bail out Greece. One day, a deal to bail out Greece is on. The next day, it's off. Yesterday morning, on Wednesday, the 24th, we saw Fitch downgrade the sovereign debt of Portugal. So this is the sovereign debt crisis steamrolling on. There will be times when it looks like it's abating. There will be times when it looks like it's not going to impact anybody but Europe. However, as you've been hearing from me and in my newsletters, writings, and these videos, the sovereign debt crisis is the biggest consequence of the financial crisis that began with the real estate market a couple of years ago. The real estate market imploded not only in the United States, but also quite dramatically in Europe as well. And real estate is the underlying collateral for most of the debt that's out there in the private sector, and really indirectly in the public sector as well. Because now you have sovereign states that have pumped so much fiat money and issued so much debt over the last couple of years to try and avert a financial meltdown in the real estate industry and in the economy, that now what we're witnessing is really a collapse of governments worldwide, with the exception, of course, being Asia right now. This sovereign debt crisis will definitely hit the U.S. shores. It's going to move towards the U.S. government, towards Washington, and it probably won't be here in full force, a Category 5 hurricane, for another year or so. In the meantime, however, it is going to impact markets violently, dramatically, and we're going to see markets in various sectors gyrate dramatically. Right now, the euro is getting hit the hardest. The dollar has jumped to the upside. If you take a look at this chart here, which I'll zoom in for you, this is basically the same chart I've been following all along for you. You'll see that the dollar index on Wednesday spiked higher as the euro fell. And this is out of concern, of course, that Europe is not going to be able to withstand the civil strife and the debt implosion that's going on there as a result of Greece's problems. Greece will definitely probably default very soon if they're not rescued. They could be rescued. It's too hard to say. They probably will be rescued, but it would be nothing but a short-term patch. And again, we saw Fitch downgrade Portugal as well. So right now the dollar in a short-term basis remains bullish. Intermediate-term basis, I would say neutral. Long-term, definitely still very bearish for the dollar as the sovereign debt crisis works its way from the east to the west and hits our shores probably no more than 12 months from now. Gold is reacting on the downside right now as a panic flight to safety in the dollar occurs, and as investors in Europe look to basically liquidate assets, free up cash, and run for cover. This is a temporary phenomenon in gold. The long term remains up in gold. There's no question about that. Short term, we're seeing gold get sold off a bit, but look at this gold chart. This is the one I've been following for you all along. I called these twists and turns here for you. I told you last week we'd probably trade back down to the horizontal support line here, maybe even this uptrend line and this confluence of technical support here. And lo and behold, that's where we are now, about 1090. Gold could move down to 1080, 1060. For some of my shorter term trading services, I took profit on one position and raised stops on a couple other positions that are longer term. If you're a core gold holder, do not be fazed by this action in the gold market at all. Do not let go of your gold. Only short-term traders should be trading the ins and outs of the gold market right now. Investors with a long-term view should hold all of their core gold holdings, and even look on additional weakness in gold to accumulate more on my signals. Let's now take a look at the Dow, which is very, very interesting in here. Let me pull it down for you here. There we go. Last week I told you the Dow would test the 10.8 level, which was a technical resistance area. We have just yesterday on Wednesday plowed like the dollar right up through this resistance area, and we're now trading at 10.888. We will probably reach 11, maybe 11.2. My maximum for any move higher here in the Dow would be 11.6. That's about as high as it can go right now. We are approaching a short to intermediate term top in stocks. The short-term cycles in the Dow have been difficult to trade. I do not want to be aggressively long stocks here. I do want to be looking for a top. I do expect the Dow to trade back down towards as low as 9,200. Excuse me, I have a crick in my throat. Going into the early to late summer. But I will say this, my long-standing forecast for the Dow, if you're not aware of it, is that the March 2009 low in the 6,400 level was the bottom. And longer term, we will see new record highs in the Dow going out to 2015, 2016. The reason for that is we will see a monetization of all premium types of quality assets, of which blue chip stocks are a premium quality asset in today's environment when confidence in government is crumbling. We have seen that historically in the markets on a few occasions, and mostly in emerging and third world countries that have had debt problems, where the stock market has become an inflation haven, a safe haven against government mismanagement and depreciating currencies. Sorry, I have a crick in my throat. We will probably see that also occur in the United States. Till next week, this is Larry.